Welcome to the Apartment Investor Show, where we help you get smart and invest smarter with multifamily real estate. I'm your host, JC Castillo, founder and managing principal of the Multifamily Property Group. And joining me, as always, is my good buddy, my co-host, Mr. Paul Peebles, national underwriter for Old Capital Lending. Paulie, how are you doing today?
I'm doing great, JC. Guess who's with me today?
Well, he looks pretty familiar. He might be the missing link to your Old Capital podcast, if I'm not mistaken.
Yes, he is. That's the governor, the mayor of Beckerville, USA, Mr. Michael Becker.
Hello. Hey, appreciate you guys having me on.
Hey, Mike, thanks for joining us, man. We do appreciate it. Well, since we've got Mike on the line today, we figured what we do is we talk about the top ways not to sink your multifamily ship when it comes to lending. And really, there's no better expert out there than, I think, Mr. Becker here, who spent a very long amount of time doing multifamily lending. Paulie, why don't I let you give a little bit more background on Mr. Becker here?
So Michael has been in the multifamily real estate world for a long period of time. Prior to being an owner of real estate, he was a loaner of money. And so he used to loan tremendous amount, billions of dollars for a large regional, national, large all of them bank here in Texas. He led his division multiple years in a row doing commercial real estate lending. So he comes from a background of kind of knowing what a banking person should know, like an underwriter or approval person. And then when he transitions with his group, with his partner over at SPI, they became owners of real estate. So Michael and his partner, Sean, they purchased over 7,000 apartment units. So he is a thought leader in multifamily ownership, in multifamily in Texas and throughout the nation. You may have seen him on stage a lot of different places, but he's the guy that you want to listen and learn from. So he is Michael Becker.
Hey, a lot to live up to. Thanks for having me on.
We appreciate it, Michael. And I think let's jump right into it, right? I mean, I think, look, there's a lot of viewers out there that are listening to the show or watching the show, and maybe they're just getting into real estate. Maybe they're just getting into multifamily. And, lending is a big part of the stack because let's face it, you're talking, 65 to 80% of the capital stack on a deal is coming from the lender. So today, I think what we'd really like to talk about and what we'd like to hear your expert opinion on is we'd like to talk about some actionable things that the viewers out there can do to make sure that they don't sink their ship when it comes to getting these big multifamily loans with these lenders. So why don't we let you talk about it, walk us through some actionable steps that you, from your experience, know that people should avoid doing to make sure that they steer clear and stay in the good graces of these lenders.
I mean, I think there's a couple of ways you can talk about it. So we'll talk a little less. I think you guys have covered it before about some of the things you need to do as you're acquiring the loan, and we'll spend a little more time on now the money's out the door. How do you interact and communicate with your lender? Because that's one of the things, unfortunately, I had to do for a long period of time was be not only originate loans, but manage the portfolio that we originated. So have a pretty good concept of both sides of the desk. And these larger national lenders and the agency lenders, they tend to be separated in their departments. So it's very rare to, I think, have both levels of experience on both sides of it. But first, kind of when you're up and running and you're trying to get a loan, I mean, I think really, your lender's your friend. They're going to give you it's a pretty formulaic process from the standpoint of what the data is that you need to provide. So, your lender is typically going to give you a checklist. So, you're going to need to make sure you provide them a T12 or trailing 12 financial statements. So the last 12 months of operations broken down monthly, because the lenders are really not only looking at what the last 12 months of operations are, but kind of the trends of your revenue and your expenses, and make sure it's kind of going in the right way, or if there's some declination in the trends, what's kind of behind those numbers and the trend, and is that sustainable going forward? So it's kind of the first thing you make sure you get together. Another thing to pay attention to really is kind of, making sure you have a pretty good detailed operating budget going forward, at least 12 months. So preparing something yourself, as well as with your management company, kind of collaborating together to get a pretty detailed budget as you're getting into the lending process. That is certainly going to be pretty critical. A couple other things on the front end that you need to make sure you pay attention to is getting actual insurance quotes. So, when you put your budget together, you can just put like swag number in, something that you kind of use as like a rule of thumb. Look back at maybe if you have multiple owners, multiple properties, look at other similar assets and what they would you pay on those type of assets. Maybe use that as your initial plug. But once you get into it, you want to make sure you get loss runs from the seller. So any sort of going back 5 years, any sort of actual losses that have occurred on the property, that's what loss runs are. So you kind of see the date of the claim, the nature of the claim, and the amount of the claim paid out. And then give those to your insurance broker. Make sure you have that put together so they can incorporate an actual quote for you. And then that's either going to be higher or lower, most likely than what you budgeted for. And then that helps in with the lender when they're going and doing their underwriting and sizing of the deal. And then maybe they will increase proceeds or decrease loan proceeds accordingly. And then, those are kind of the most main things that I can just think of kind of off the cuff as we're going in, trying to size the deal. Usually when your lender's asking for something, it's not usually a good idea to push back on them because they need it. They're not just asking because they want it. They typically have a purpose and a need that then helps craft the underwriting memo or the credit memo. They're going to go into their loan committee or to the loan approver and go actually get it approved by the credit officer. So these are some things that, working with a competent mortgage broker like Paul or one of the guys at Old Capital, they have a lot of experience on thousands and thousands of loans. So they kind of help you put this together and size it up, and maybe even help you if you're unsure about how to create one of these documents, or what the heck the lender's actually asking for in English. They can come translate that for you and put it together.
One of the things I want to ask, Mike, you worked for a large national bank and as a loan officer.
Yeah.
Were you the decision maker? So when someone would bring all your paperwork in and they would give it to you, were you the person who made the decision?
No. So they have clear lines of separation between loan originators and credit approvers. So you can't go in and originate a loan and go in and approve it yourself, because your compensation is typically, as a loan officer, tied to loan production or growing your portfolio or some combination of those two things. So they want to make sure they separate those functions. So your loan originator is kind of like your gatekeeper into the bank. They're the ones that's kind of your advocate. They're the ones that are in there helping you present the best story in the best light, so then they can then increase the probability of approval with the loan committee or with the credit approver, depending on how the bank is set up.
So the loan gets approved, you operate the property.
Yeah.
What are some of the things that can sink your boat, whether it is innocently or you're deliberately doing bad boy things?
So with any loan, there's going to be a loan agreement, and then within that loan agreement, there's going to be like covenants, and reporting requirements typically. So those are really kind of what governs what you can and you can't do at your property or with your financials. So some common covenants and loan requirements that you need to make sure you pay attention to is there a minimum debt service coverage ratio going forward? So if you break a certain debt coverage ratio going forward, is that a event of default triggers default where the bank may potentially accelerate your loan? That's not very common, like within the Fannie Freddie type product, but that might be something if you have a bank loan to kind of pay attention to. The worst, most egregious one is what's called either insecurity clause or nervousness clause, where for any reason at any time a lender can then trigger, if they just feel nervous about your loan, they could trigger and accelerate the maturity and call you in default and make you want to pay it off. So those are even less common, but those were certainly in some of the canned loan documents we had at Wells Fargo when I worked there. So that was something we could always strike through, but just make sure you pay attention. Your lawyers should point all that out to you. And then there's a lot of these things have maybe a liquidity maintenance covenant, where on an annual basis you got to prove to the bank that you have a certain level of liquidity, 100,000, 500,000, either in cash or marketable securities or bonds, something like that. That on an annual basis you provide those statements, and if you don't, then that's the trigger where you can be in default. And then really on an ongoing basis, most of these lenders want you to report at least on a quarterly basis. Rent roll, and most likely a year-to-date income statement as well. And then on an annual statement, a complete financial statement with a balance sheet, rent roll, et cetera, on an annual basis. And some of the banks also want to have tax returns also sent in on top of that. And then if the loan has a guarantee or there is a key principal that signs the bad boy carve out, either you have to provide an updated personal financial statement, or there might be some sort of like ongoing form that they want you to sign off and attest that you're not in bankruptcy or default on any of the loans, things along that line. And if you don't follow these things and you don't report on a timely basis and you hide the information from your lender, those are things that start getting them nervous and start asking a bunch of questions and start taking more aggressive actions if you just simply go dark on them.
Yeah, and we've seen that before. So don't be a bad boy with some of these clauses. So let's talk about some of the things that you, again, have seen that could sink your boat.
Yeah, I think a couple things come to mind. When you have a multifamily property, these municipalities, you have certain zoning, and you have a CO, and you're lawfully able to operate this as an apartment complex for a certain number of units. So if you have like a storage building or something, and you want to go in and update and add a couple units, you don't go through the proper channels, both with the city to make sure it's properly permitted, inspected, and up to code. And then two, with your lender, either if you want to add units or if you want to say, hey, take a couple small efficiencies and make it like a 2-bed unit or something and decrease the number of units. Either way, that could potentially trigger, or most likely will trigger, a event of default within your loan documents. So making sure that you operate the thing lawfully with the way you're licensed with the city, local municipalities, as well as you don't modify the collateral without prior written consent from your lender.
Yeah, so what would happen is that the money's out the door with those people, but they can change it from being a non-recourse loan to a recourse loan. Yeah. So another thing to be observant on is that if you are thinking about changing from 100 units to 102, 103 units, make sure you check out with your lender, number one, two with the city, because your lender is going to require some additional forms to be filled out that maybe changes the original loan terms of the deal, because they added securitized with 100 doors, not 102 or 103. So it could cost you significant cash up front. Yeah. Give me another example where you could sink your boat.
Yeah, a good example that comes to mind was a client that Paul had several years ago had a large hail claim on a property here in the Dallas area, and didn't took the insurance claim, never told the lender about it, right? So that turned out to be a pretty big problem.
That was a problem.
And ultimately ended up taking the loan from non-recourse to recourse, not only for himself. I think he had probably 2, 3, 4 other key principals alongside him that then all of a sudden went from having, what they thought was a no risk or low risk loan, all of a sudden became pretty risky because the bad boy carve outs were triggered and the guaranteed was sprung in on them. So that was certainly a challenge, and ultimately ended up getting kicked out of the deal. And I think what they called H-Act. So that's when Fannie Mae puts you on the list, the bad boy list.
That's the list you don't want to be on.
It's called H-Check. You don't want to get on the H-Check list, and then you're unable to then borrow money and do future deals.
One of the things right now that what we're seeing too on the lending side is rehab problems.
Yeah.
And talk a little bit about rehab.
Yeah, when you're buying these properties, the lender will go through and do their own property condition report or PCA, property condition assessment report. Well, they'll go through and sample some units, walk through the major components, and they'll schedule. With that, they put out the replacement reserve schedule. So, for the next 10 years, you need to escrow $200 or $300 a unit a year and replace reserve escrows, as well as identify any sort of immediate items like life and safety stuff, like you don't have proper fire detection equipment or fire extinguishers or trip hazards, or just, potholes in your parking lot or road rot needs a paint job, whatever it is. And they'll make you escrow some money up front to correct those items. And then they'll give you a timeline within that you're supposed to correct those items. So you have 6 months or 12 months or 90 days, depending on the severity of the life and safety aspect of it. So if you have that, as well as if you're doing these Fannie Mae loan in particular, or a bank loan, and you're doing a reposition of an asset, you're going to spend some CapEx dollars. They'll tend to escrow those and give you a certain time period you're allowed to get it done per your loan documents. So if you have a year to get this stuff done, and you decide to buy the property, you don't spend any of the money, it's sitting in escrow, and then you're here 2-3 years later and you haven't done anything, that's going to cause you problems with the lender, because they also, want you to submit draws to prove that you're making progress towards achieving those goals, as well as they'll send out actual inspectors to verify that. And then on an annual basis, they tend to come do a physical inspection of your asset and identify any new additional stuff that you may need to address that popped up on the property. So these are things that start get you in trouble. And then that's going to also be an event of default within your loan, or spring in the bad boy recourse from non-recourse to recourse. on the KPs.
And some of the things that we've seen recently too that's been a problem is that a lot of people signed as KPs on these transactions to kind of get their Fannie Mae Country Club card to do a deal down the road. So they signed on maybe somebody else's deal just to be a KP, not the managing member, but just a KP. They put their net worth, their balance sheet.
Maybe they do it for a fee too.
They did it for a fee. They may have done it for a fee, but with the thinking that maybe they were going to do their own deal down the road. So what had happened is that maybe the deal they signed on originally, that rehab wasn't done, or that deal is not performing, and now they want to try to do their own deal down the road. Well, Fannie Mae is going to uncover that you didn't do all the rehab up front, or that deal is not performing when you go do your own deal. So then you go on the bad boy list, and then you may not get a chance to do your own deal. So make sure that when you do sign your name to these deals, make sure that you know that that property is going to be performing if you want to bridge that, so to speak, into doing your own deal.
Yeah, and there's risk in all these deals. None of this stuff is risk-free. So if you're thinking signing on a non-recourse loan is not a big deal, I can make a little small payday, it might have further ramifications and kind of take you out of the business altogether if you choose the wrong sponsor or the wrong deal to do it on.
Yeah. So those are just some of the things that I think are important for people to kind of understand, at least right now, but where the market is for Fannie Mae. Mike, tell us a little bit about where you're seeing Fannie Mae and Freddie Mac. We're coming up against the end of the year coming up fairly soon. Any worries, any nervousness on that?
Yeah, maybe just kind of give we're in the market always, constantly, both in the capital markets, debt equity, as well as within the apartment investment sales market, trying to buy and sell these deals. So we're constantly, the one thing that's always sure about this business is constantly changing, and there's always updates. So we're kind of late August 2019 as we record this. So kind of this is the most current kind of state of the market, in particular with capital markets on the debt side. For many, many years, Fannie Mae, Freddie Mac have kind of been, the bellwether lenders. They've been loaning, well over half of the money in the multifamily debt space has come up from one of the two agencies.
Yep.
And they ever since the recession, a decade or so ago, they've been owned and in receivership by the federal government and the regulators, FHFA. And recently, FHFA has had a new head come in the search. And for the last several years, they've had a cap on the maximum amount of business they can loan. For 2019, it was $35 billion each, so they can loan up to $35 billion. But there was an exception to the cap where they do what they call uncapped business without any sort of limitation, and you had to either fit into an affordable product, because one of their missions is really to provide safe, affordable housing. So if you had a certain level of affordability, which was a test on the area median income and your property and your rents, et cetera, that would fall outside the cap, or if the property was eligible and you agreed to do some green rewards program and do some energy improvements by saving 15% both in water and energy by doing some improvements to your property, that also would fall outside the cap. So what had happened in 2018, a lot of the business was uncapped by either being affordable or green, and they didn't come close to the actual cap because of the stuff that was on the cap business. So rolling into 2019, they weren't, I think, really paying attention to be kind of editorialized what I think has happened here. And the first 3 to 4 months of the year, they were just throwing everything and giving big pricing waivers and putting it where it was hitting the cap. They weren't making people do green. As we're looking, and you would look at it both ways. It's like, well, I could get basically the same price by doing by not having to force me to spend $100,000 or $200,000 to do all these energy improvements in my property and get the same pricing break. So I'll just do this versus spending this extra money.
Right.
Because at the end of the day, if it doesn't make dollars, it doesn't make sense to most people. So why spend the money if you're not going to get an economic return? Where previously in 2018, you would get maybe a 30 to 40 basis point price break to do the green. So they just started filling their cap up so early, and it seemed about like April or so, I kind of woke up and kind of the OS moment thinking like, okay, we're gonna hit our cap by September at this pace. We need to start pausing and let's start forcing stuff into the green. So then from that moment forward, there's no pricing waivers unless it went green. And that kind of ran on till, probably about June or maybe even early July, the 4th of July. Then FHFA has this new regulator come in and starts like really, really throttling back their production. And they really kind of don't want them to do 70 billion when they have a $35 billion cap by just forcing a bunch of the stuff into the green. So they're just right now, all the spreads have widened. There's no pricing breaks. There's no waivers to the price right now. So everything in the last, call it 60 days, 90 days, really has gapped up about 100 basis points on the spread. So meaning what would have been about a 1.5 spread now is about a 2.5 spread in the last 90 days. So that's coincided with the treasury rates plummeting. So, a lot of this, the benefit, the savings that you would get by having a lower 10-year treasury rate, which is what the index that a lot of these stuffs are priced, these loans are priced off of, has been all eaten up with increased spreads. So instead of, we would have similar spreads that we had 90 days ago, we paid about 3%. And it seems like Fannie's trying to put about a 4% floor, give or take, in the market.
Yeah, instead of just tapping the brake, they're slamming on the brakes right now. So just know when you're putting together these transactions, understand that your pricing, your interest rates may be a little bit higher than what you thought they were going to be
90 days ago.
90 days ago.
Still pretty attractive, still from historical standards, JC, still, kind of that 4% range. But what would have been with the spreads from 90 days ago, 3%, they're not letting the market kind of go to the low 3s on these 10-year fixed rate money, which is sad for guys like you and me, for sure.
So I would probably imagine sometime early part of next year, it should be fine. But right now, going into the end of the year, it's going to be a little bit challenging.
Yeah. So there's two things to kind of elaborate a little bit on kind of the ramifications I'm seeing from that set of facts I just mentioned. One, just it's more and more important now to have a competent mortgage professional on your team, because, the last 5 years, almost a blind drunk monkey could just go to Fannie and Freddie and do one of the two, put them against each other, and they're going to win 90% of the races. Where right now, that is not the case, right? So you need to make sure you have a Rolodex of banks that have these banks products that the spreads are a lot tighter, leverage is still a little bit better, and then two, life companies or CMBS type products as well are now back and actually viable, where the agency was just taking all the business. Those are now becoming more attractive. So you need to be more strategic and specific, and you need to shop a little bit more on what is the right execution to fit my set of facts and what I'm trying to accomplish at the property. Paul, anything to add?
Nothing, JC.
Well, what kind of terms are you seeing out there, Mike, for CMBS / life insurance type?
So we just quoted a deal the other day, and what we got a Freddie quote, I think, was for 7-year term, floating was about a 2.56 spread over 2.55, 2.6% spread over 30-day LIBOR, where go back 90 days, we got a quote and we closed on a loan back in July, a 1.56 spread over 30-day LIBOR. So it gapped up 100 bips. So we started shopping, and, we have a little bit of size and a little bit of scale and have, bigger loans, a little nicer asset, but we just got a quote from a life company, 7-year full-term IO at 190 over 30-day LIBOR. So it's, 70 basis points better than the Freddie alternative, and you're borrowing, $20+ million of stuff. I mean, it adds up on $1 million. It really adds up when we start, scaling the size of these deals. You're talking about hundreds of thousands of dollars a year and increased debt or interest expense, so that's kind of what I'm seeing right there. Before you have any questions, the other thing I'm kind of seeing what's impacting the market. If you don't have any more questions on this, I can go to that.
Yeah, please do.
Yeah, the other thing, which I've lived through firsthand here, unfortunately, on the bad side of it, is if you were a smart guy like me a few years ago, you put 10 or 12-year fixed rate money when you're thinking, hey, the rates are kind of in the high 4s, they're never going to be lower than they are right now. Let's go ahead and lock this thing in, and oh, this is getting so great. We're going from years IO, and it's never going to be better than that. And then now you fast forward to today, and everyone's getting 5 to 6 years of IO on a regular basis, and the rates, like I mentioned, are now at 4%, which is up from the kind of the mid to high 3s 90 days ago.
Sure.
That what these large long-term fixed rate loans, they have either defeasance or yield maintenance prepayment penalties with them, which basically is a formula that kind of compares your rate of your note to kind of what the current market conditions are. So if you're if you have a 4% loan and the current market rates are 5%, your prepay is going to go up because your note holder, when they sell it, it's going to have to replace your income stream that you're providing them with bonds at a lower interest rate. So your prepayment is going to have to go up. And the inverse is true. If the rates were higher than when you originated, your prepay would go down. And then also the other function is really time. How much time is left until maturity. So that if you have 7 years left, your prepay is going to be higher than if you only had 4 years left, because there's less time to kind of cover. So with these basically year to date, 2019s, like I said, we're the end of August as we record this. The 10-year treasury has declined over a full percentage point from January 1 to today as we're talking. So what has happened is these yield maintenance prepays have exploded. So we had a deal that we were going to sell, kind of the high 30 millions, and we had a loan in about 23 million, give or take. We decided we launched it around NMHC, so in January. So kind of as we're first a year signing the listing agreement, we looked at the prepay. We're going to offer it both free and clear, meaning we'll just eat the prepay. Someone can put a new loan on it, as well as a loan assumption. So we get in, had a little bit of struggle with marketing it a little bit, finally get a good offer, get it in escrow in May. And when we decided to market it, our prepay was in the low 3 million, JC, 3.2, something like that. And then when we on 23 million, when we decided to sell it as an all cash deal, we had to eat it up. The seller paid a high premium, and our prepay is about 4.2 million. So it had risen, nearly $1 million, give or take. But that deal made economic sense. And then we ended up crying uncle about July 4th, when it went from about 4.2 million to over 5 million. And then as I talked to you today, looking at my loan, it'll take over 6 million to pay off this loan. So in the 8 or so months that we've kind of had it this year, my prepays went up, nearly $3 million on a $23 million loan. And that's absolutely killing these deals. And we ended up having to back out of the deal. And this wasn't economically viable for us. So I think a lot of these people, I've heard a few other people kind of experience similar things, because this is a real issue in the marketplace right now. So make sure as you're going out and you're listing these deals, you understand what the yield maintenance prepayment penalties are going to be, because a lot of these deals that might have traded now are not going to be able to trade because people can't make economic sense of paying an extra $1 million or $2 million and basis on this deal that the seller is going to need to make economic sense for them to eat that prepay.
It's such a great point, Michael. I mean, I think if you think about it, right, if you're talking 4 or 5 or 6 years ago, if you were buying deals even back then and you were putting 10, 12-year Fannie Mae debt on those things, if you're selling those deals in the last couple of years, you probably are still paying a pretty decent prepay, but you're probably thinking, well, we're still really crushing it with the sale. Yeah. But I think it's like you said, right now in the market that we're in, you're not going to see that sort of appreciation going forward. So if you're still putting 10 to 12-year debt, but you're thinking that you're going to sell the deal in 3 to 5 years, you're simply not going to have the type of appreciation that's going to make it worthwhile for you to both sell and pay the prepayment penalty off and still make a buck. So I can't agree with you more that right now it's critical to really match the loan to your exit. If you think that you're not going to be in a deal for 10, 12 years, this isn't the time to be putting Fannie Mae, Freddie Mac debt, in my opinion.
Yeah, that's right. So that's always been good advice. And, we were trying to be smart a few years ago, thinking that we'd have a below market rate loan that we can sell and someone can assume it. But I think it's a good real life lesson that, no matter what you think, you're making certain investment decisions and lending decisions on the information you have today. Just know that the future is going to be different than today, better or worse, whatever it is. It is both better and worse right now than what it was 3 or 4 years ago when we did some of these loans. So just the only thing that is certain is going to be different than in the future than what it is today. So just trying to match your debt and your maturity. Maybe have a little bit extra runway. Don't try to put 1 to 2 year bridge loans, and don't give yourself any sort of margin for error. But do that within reason. And right now, some of these floating rate loans, the caps on them, because the lender will typically make you buy an interest rate cap. They're so affordable that you can hedge a lot of that risk for very little upfront money as well.
Absolutely. JC, anything more to add?
No, I think this was a great and timely discussion, Michael. I mean, if viewers out there want to get a hold of you, how can they best reach out to you?
Yeah, really it's two ways. Paulie and I host the other podcast Paul does. I think Paul's always doing podcasts, but it's the Old Capital Real Estate Investing Podcast. So You can find us on iTunes, or Stitcher, or YouTube, or probably anywhere you're hearing JC and I talk right now. You probably can find our podcast. So you go to our website, which is the oldcapitalpodcast.com website. You can find information there. Or the way I my primary business, what I focus on, I spend the vast majority of my time doing is it's called SPI Advisory. That's where we go out, raise capital, put together these larger scale multifamily syndications. So you can find information about me at spiadvisory.com. That's SPI like spy at advisory.com. If you go there, hit the contact us form, fill that out. I'm always happy to have a 10 to 15 minute telephone call with people I meet off a podcast.
So JC, what's the best way for people to get a hold of you?
Well, if people want to reach out to us, they can go to multifamilypropertygroup.com. They can reach out to us through email or contact us, and we would be happy to help. We've been in the business for a very long time, since 2006. So our company has been through the Great Recession. We came out fine on the other side, and we're all about helping people, just like Michael Becker is. And if anybody has any questions, want to reach out to us, they can feel free. Polly, what do you guys got going on the Old Capital side besides the Old Capital podcast?
Well, coming up October 24th, 25th in Dallas, Texas, we're going to have the Old Capital Multifamily Conference for 2019. That is always a great event. Coach Lou Holtz will be our keynote speaker. Michael Becker says, and I think it's great, is that most people are not going to knock on your door and hand you a $10 million transaction. You got to come and meet the people. So networking is a big deal. This is just not a regional conference. This is a national conference. You're going to have 600-700 people come in to Dallas from all parts of the United States. They're going to want to meet you. You're going to want to meet them, build some relationships. That's a good way to establish great camaraderie with people and find ways that you are able to know, like, and trust to invest money with them. So go to oldcapitalpodcast.com, oldcapitalpodcast.com, and download RSVP to the conference October 24th, 25th. Anything more to add to that?
Yeah, no, I think I've been telling Paul here lately, I think the prices are, a couple or a few $100s for this ticket. I think the value you get is, exponentially more than that. Because if you get out, you get to network people, you meet somebody, get one relationship to being millions of dollars to you potentially, or hundreds of thousands of dollars to you potentially. Or if you get one piece of nugget, one of the panels I'm looking forward to is Paul's going to have a bunch of very seasoned, experienced operators with 20 to 30 years plus of experience, been through multiple cycles. They're going to get up there and kind of tell you and give you some tips about how not to lose all your money doing these deals, because we're relatively long in the economic cycle right now, being about a decade in economic cycle. And you get to hear actually what these really seasoned, successful, very wealthy investors are doing right now to kind of position themselves for the future, with some of the lessons that they learned the hard way back in the 80s, and then again in the most recent recession from 10 years ago. So I think if you just learn one thing, you just meet one person, you should get 100x return on your $300 investment to come out to the conference.
Do you think we should raise our prices, Mike?
I think you should. So
all right. Get your tickets before I raise the prices.
That's a good deal. Get your tickets before he raises his prices. Okay, well, Michael Becker, Paul Peebles, thanks a lot for joining, and I think that's it. We are signing out. Have a good one.
Thanks.
Bye.